Hey guys, good afternoon and welcome to the CNBC-TV18 Mumbai newsroom. I'm Pavitra. With me is Sonal and you're tuned into MF Corner. Today we're going to discuss a new fund on offer by Bandhan Mutual Fund. The AMC has launched the Bandhan Financial Services Fund, which looks at 5 pockets within the space. So it will give you exposure to banks, NBFCs, capital markets, insurance and also fintech. So there's really a lot for us to discuss here in terms of what the portfolio construction approach is going to be, the composition of this fund. And, for a viewer who's watching us, does it make sense for them to invest? So who it's really best suited to?
Okay, so let's get in our guest for the show today. Joining us is Manish Gunwani, Head of Equities at Bandhan AMC, to answer all your mutual fund queries. Mr. Gunwani, thank you so much for joining us today on CNBC TV 18. And, this is a new fund offer. So tell us about the new fund and why did you decide to launch a financial services NFO now?
So typically when you look at a sector fund, the tick boxes you need to check out are basically that it should be a large sector. Structurally, it should have the potential to grow faster than nominal GDP over the mid to long term. It should have a lot of variety of companies so that whenever the macro of the global economy or domestic economy changes, the fund manager should be able to alter the portfolio according to the macro that is there. And when you, if this is the desired checklist, we figured that financial services checks all these tick boxes. It is a large sector, not only in the market, I know in the index it is big, but it is the biggest component of the services vertical, and the services vertical is the biggest component of GDP. Almost 57% of GDP is services, and this is roughly 37% of services itself. So within the GDP, within the economy, it's a large sector. It has tremendous growth potential. So the interesting point is any country which is developed more than India, Japan, US, China, if you see the credit to GDP, that's around 200% or more. India is at 88%. So what it means is, as we all believe that India will catch up with these kind of developed regions in terms of GDP, credit, which is the key driver of the earnings for this sector, should grow much, much faster than GDP. And that typically means that the earnings growth of this sector should outperform the earnings growth of the headline index of the stock market. So in terms of growth, in terms of size, in terms of the variety of companies it has, all these are, I think, are tremendous advantages for the sector. And we felt it therefore natural that we have a fund in this sector.
All right, that point is completely well taken. And Mr. Gunwani, a lot of times when we talk about this space, the conversation just gets very heavily skewed in favor of the big banks, right? We forget that there's a whole ecosystem as well that poses a good opportunity. But take us through what is the kind of growth you expect for the entire financial sector space over, say, 1, 3, 5 years, if you could give us some numbers and help us with that.
So you're correct that I think some of the smaller parts of financial services, they typically are more leveraged to the growth of the income of the country, in the sense that, see, banking is a core need. So it has grown well over the last 30, 40 years. But some of the capital market related segments like AMCs and broking, the penetration is far, far lesser than banks. So I think the big growth for these sectors is much ahead of us. So if I look at the sector in totality, basically, if we take the lending part, which is the banks and the NBFCs, as I said, I think they should broadly grow maybe 200, 300 bips over nominal GDP. And I think the capital market related parts, the insurance related parts, should probably grow faster than banks on an aggregate. So I think mid-teens growth for the next 10, 20 years should be easily achievable for the sector.
Okay, so, Mr. Gunwani, this is a financial services fund. You spoke about how it includes a whole host of segments, banks, NBFCs, insurance, there's fintech as well. What is the current breakup in terms of your fund allocation?
So clearly, a lot will depend on the valuation when we deploy the money and the macro that we deploy the money. We obviously are very value-centric investors in the sense that we will not own anything for the sake of owning it. in general, what has happened is this is a sector where, we have a lot of skewed market cap in the sense that the large private banks and one or two large PSU banks, if you take the market cap of these players as a proportion of total market cap of the sector, it's very high, which is why the index also tends to be top heavy. So the top 3-4 weights in the index are very, very big. Our philosophy more is to be a bit more active in stock picking. So I think versus the index or maybe versus peers as well, we intend to have a bit more active approach where, we will find the next winner who can grow much, much faster than the sector for many years to come. We will try to find the stocks which are getting market share. So there's not only the tailwind of the sector growth, there's also the tailwind of a great management team executing well and getting market share, because that is where we will get the buy and hold winners. And if you see historically, companies like HDFC Bank, Bandhan Finance has been very good for buy and hold investing over multiple years. And I do believe that this sector in both lending and non-lending spaces will throw up such big winners. One of the reasons I think that will also happen is technology is becoming a bigger part of this sector. And technology typically tends to produce large winners and large losers. So if you can catch a large winner and hold it for a fair period of time, I think you should generate very healthy returns. And by technology, let me clarify, I just don't mean the pure fintech plays in payments or broking or anything like that. They are, of course, interesting by themselves, but it also means any management team which in a traditional business like lending is able to leverage technology better than others, and that obviously will lead them to gain market share. So there are a lot of dynamics like this where we believe that by being active in terms of stock selection and probably having a bit more of the smaller companies, we can generate substantial alpha over the index.
Okay, that's very interesting. But something else that we also want to know is if we can just dive a little bit deeper into this, take us through the approach that you're using to construct this portfolio. Is there a certain minimum amount that you will be allocating to all of these subsectors? And also, what is the stock selection model that you have in place here?
So, no, to be honest, we will not have a rule because, let's face it, a lot of this sector's dynamics depend on domestic macro. So, there will be times when, like today, I think India's macro is looking superb versus the global macro, right? And so, relatively, India is in a very, very strong footing, whether you see current account deficit, whether you see growth, whether you see geopolitical situation. But things will change, right? I mean, we saw 2013 when current account deficit was 5-6%, and then you need to be careful on currency. So let's not, I don't think it makes sense to have one rule and say, and as I alluded, this sector also offers a lot of non-lending spaces which are more secular and which can do well, even if there is a temporary downturn in India's macro or in India's growth. So I don't think it makes sense to have a rule saying that you will have X% in banking, Y% in NBFCs all the time. But just in terms of portfolio construction, as I said, ultimately it is an interplay of three things, which is the business model, management, and valuation. The good part is if you can get a business model and management team which can execute, the landscape is there. The sector size is so big that even with expensive valuations, it has historically worked, and I think it will work in future as well, that if you can hold a good business model and good management for long periods of time, it should generate very healthy returns. So in that sense, our focus, especially for the small and mid-cap companies, will be very skewed towards evaluating the business model and the management so that we are convinced that that company can get market share and grow faster than the sector over long periods of time.
Okay, interesting and helpful. Mr. Gunwani, it's an interesting chat. We'll just do one thing, slip into a quick break, and on the other side, we'll continue analyzing the NFO and speak about a lot of other opportunities as well. Stay tuned for that. Welcome back. You're still tuned into MF Corner on CNBC TV18. We still have with us Manish Gunwani, Head of Equities at Bandhan AMC. We are discussing their new NFO. Mr. Gunwani, there are several such funds available in the financial space as well. What would you say sets Bandhan's NFO apart?
So as I mentioned, we think that we have a great research team, a great fund management team, and therefore we think we'll be more active. So you're correct. There are a lot of funds in the market. And generally, we feel that most of them are fairly benchmark-centric and top-heavy. Our effort is clearly, as I said, to have active stock picking as a differentiator, where we would be looking to create differentiated returns by having a portfolio which is more skewed towards what we think are the winners within the sectors. So clearly, apart from riding the sector growth wave itself, what we're trying to do here is to have a very sharp focus on alpha creation, so that the return is a combination of the sector growth, which is going to be healthy by itself, but also in terms of our alpha adding to the entire return of the fund.
Okay, so I think now you've really sort of explained the length and breadth of this fund to us, what the portfolio construction is going to be, how you'd go about selecting stocks. But now tell us, Mr. Gunwani, who do you think this is well suited to? Because sectoral funds come with their own set of risks, right? And also, if an investor is getting into this, what kind of time horizon would you suggest when looking at this product, but also any such product in the market?
So there are a couple of viewpoints you can look at this fund for. So see, typically the sector funds are of different types, but broadly, if I look at them in two categories, one can be very cyclical, like a commodities sector fund, for example. But I think this fund meets both the requirements of a core allocation fund as well as a sector fund. The reason I think it's suitable for a core allocation fund is basically that it is a very large sector and it has a lot of variety. So it need not necessarily be a high beta fund. I think that's what is different about this universe versus 10, 12 years back. That if a fund manager, let's say, running a sector fund like this 12 years back, wanted to de-link from the asset quality of the banking system, it was very difficult. Today, as I said, there is a big variety in the non-lending space, which tends to be lower beta, which tends to be more structural, where the penetration levels are lower. So it is not necessarily a high beta fund, like let's say commodities fund or maybe an infrastructure fund. So to that extent, it is a reasonable fund for core allocation, also in the sense that any diversified fund also has 25-30% of financials. So the difference between a core fund and this is not that much in terms of portfolio versus a pure cyclical sector fund. The other way to look at it is more tactical sector fund, in which case what are we playing? We're basically playing the fast growth of India. So you should use the sector fund then as opportunity when India is looking remarkably good versus the globe, which is the situation today. And if at all, for example, you see some of the key macro indicators of India turn adverse, like as I said, in 2013, current account deficit was very high, or you see, consumer inflation for double digits or something like that, hypothetically, then you should be turning away from this fund. But at this point, we think that investors can look at this fund from both the perspective of having a core allocation as well as a sector fund, which is you should play it when India's macro looks good, which is at this point of time. In terms of time horizon, I think it's linked to these two things. So if it's core allocation, then obviously it's more like a perpetual allocation. Your long-term allocation to equity, some part of it goes here. If you're looking at it like a sector fund, then obviously you should, more than time, it's basically, if you think, for example, there will be a great bounce back in China and growth will do well, then maybe you should reduce allocation. But at this point, I can scarcely remember any other point in my memory where the difference in strength between India's macro and the global macro is so strong, right? Because whether you see inflation, current account deficit, growth, and when you see what's happening globally, and even the subjective factors like geopolitical situation, it just seems to me that at this point, it's kind of ideal for this fund because India's macro looks so much better than the global macro.
Okay. So, you do speak about how India's macros look way better than global macros right now. So these are some of the factors that someone needs to consider before investing in this space. But, the fund also includes the fintech companies. And there are some new age companies in that space as well. One, what is the allocation here? You would look at fintech companies, and how do you look at that space generally?
So, again, the allocation in weight will link it money to see the valuation. But as a team, I think we are much more open to the fast-growing and maybe not so profitable companies in general, as long as the long-term earnings look fairly visible. So my point is this, that even if you're buying a traditional bank and if you were to do a discounted cash flow, which is actually the fundamental rule of valuing companies, I guess 60 to 70% of your value will come after maybe 8-10 years. So to say that just because a fast-growing company is loss-making and not looking at it, I think not fair, because anyway, everyone's buying stocks where the fundamental value is coming after 8-10 years. So I think we should have an open mind. If we think, let's say in 5-10 years, the profits of these companies can become substantial, then, and at that point, the valuation based on those earnings, 5-10 years, I know you need a higher margin of safety for sure, right? Because I'm not getting the visibility of next two earnings. So if I am projecting earnings on a 5-10 year basis, it is fair to say that you need higher margin of safety, but I don't think it's fair to write them off. So we will obviously seek that margin of safety when we're looking at these companies which are typically fast-growing but not very profitable at this point. And part of the reason the profits are not coming is because you're investing in geographic expansion or product expansion or customer acquisition. Now, you have to take a balanced call that if this company slows down those kind of investments, how profitable it is, what is the growth which is possible without so much investment, and then obviously look at profits 5-10 years down the line. But yeah, so just as a summary, we are definitely open. In fact, as I mentioned, the fact that technology is becoming a big part of the sector, to me, is a great opportunity, not only in terms of driving the growth of the sector, because we should remember that most of the financial products today are used only by the top 5-10% of households. There is a vast 80-90% of households which haven't done smart payments or bank loans or whatever. Now, with technology, obviously that penetration will improve, and technology, as I said, will create some big winners in terms of business models and management teams. So yeah, fintech is a very, very exciting part of the sector, and we're very keen to play that.
All right, that's another big positive of a fund like this, right? That you can get exposure to these other sectors, which are maybe a little bit tricky for individual investors, but through an experienced fund manager, it could help you get exposure to that kind of sector. One final question, Mr. Gunwani. Consider a new investor is creating an MF portfolio, right? What would you recommend their exposure to this be? What kind of allocation would you suggest to the financials or to this specific fund as well?
Look, it is one sector product. So I don't think you can put 20-30% of allocation in this fund. Obviously, 5 to 10% of your overall allocation to mutual fund is what probably this fund is suitable for.
Okay, all right, take that point, Mr. Gunwani. Thank you so much for joining us today and giving us the lowdown in this new fund or the new fund offer that has come by Bandhan AMC. With that, it's a wrap on this edition of MF Corner. Stay tuned for Closing Bell to take you through the last hour of trade.